Guys, I'd like to welcome everybody to this episode of the Advisory Board podcast. And I've got a special guest with me today, who a lot of you probably know, Tom. Say hi to everybody, and I'm going to introduce the topic in just a second.
Thanks, Dave. Welcome. Thank you for welcoming me here.
Yeah, no, well, glad to have you. So what I want to do today, guys, is frame up the topic because you're wondering why I've brought this expert in here with me. And we're going to talk about the big exit, planning for the big exit. A lot of it's really, there's so much M&A in the industry right now. So many people, franchise brands that are building that are thinking, hey, maybe I should sell. Maybe I should talk to these, the big equity firms, or maybe I should roll up into an HFC or a Neighborly or Authority Brands, or they're looking at the potential exit. And there are a couple of things that if you're not thinking about now, when you get to that point, I think you'll regret it. And so that's why Tom and I were chatting about what we should chat about. And he's like, this is the thing. Like, more people need to know this. So if you don't know him already, Tom is an attorney, one of the top. In fact, their firm is number one, according to Entrepreneur Magazine, in the industry.
Thank you very much.
And yeah, kudos, hats off. And you don't just show up on that list in the number one spot. But I'll tell you why I think they're there. One, Tom's background is incredible. He's a certified franchise executive. He used to sell franchise. He's a FranDev guy to pay for his law school bills, right? I love that about you, Tom. And so you just kind of grew up in the industry knowing both ends of what most attorneys don't know. Most of them show up with their attorney hat on and they think in that stream. But Tom's got a lot more practical approach, and he's been in the industry for quite a while now. And I'll also riff on your firm, if you don't mind, just for a second, because one thing I love about the way that they do business, and I always say it wrong, it's Spadea? Spadea?
Yeah,
law?
Spadea, that's right.
Okay, good.
But the second name's always hard. That's Liana, Spadea Liana.
Okay, thanks. I used to always goof it up. I would say Spadea all the time until I heard you say your name right. But the thing I love about the way you guys do business is it's actually, your model is designed around franchise financial needs. Like, you've got flat rate fees, the way that you guys do your FDD with the click map. Like, I just love some of the stuff you've thought up. It's creative and it's different. It's tech, and it's also affordable. So I don't want to pitch too much, but just if you guys don't know Tom, Spadea Liana,
Liana, it's close.
Liana, it's close. Liana, all right. Spadea Liana, great firm. But Tom, tell us more about you and about your experience of franchising the firm a little bit, so people know, why should I listen to this guy talk to me about the big exit?
Well, thanks, Dave. I mean, I do appreciate that. So we love what we do. I mean, I started the firm, I guess we're in our 11th year now. We represent a little over 300 brands. We were honored with the number one. And you're right, you don't just jump into number one. But I think we started at 7, then we got down to 2 for a couple of years, and now we're number one. And it's really a thanks to our clients who vote for that, and a lot of the franchisors. I started in FranDev. I had a business, did well for a couple of years, and then it all sort of blew up and did horrible. And I lost a lot of money and I learned a lot, got into franchising as a franchise broker and consultant. And I went over, to those of you that know Rita's Italian Ice. They had just been bought actually by private equity. Now, this is going back to 2005. So this is a number of years ago, but I joined, they had 300 units. I got my CFE. I had a development team. I ran real estate development, construction, and I learned a lot. Not only did I learn a lot about what is in the minds of franchisees, but also what's in the mind of private equity and what their goal is, sort of right when that got in the industry. And I really cut my teeth on that, was in a couple other brands, and started the firm. And our focus, in the beginning, we represented franchisees and multi-unit operators and just started with franchisors. Now we're 100% on franchisors. It's all we do. And our whole goal is emerging brands from people who maybe have a couple of units and want to become a franchisor. We do a fair amount of that, and then we walk people through that process and just the blocking and tackling and making sure that their house is in order, so that when they present themselves to private equity, they're ready. Right? Planning the big exit is essentially what we do day in and day out. And so you're right. Thank you on the shout out for our tech. You guys see the map I have on my wall here. So each client gets their own portal that every state shows, whether it's red or green, because some of these little tricks, right? Like, if you're not registered in a state and you don't properly disclose someone and you sign a franchise agreement, it's not going to be a lawyer who, went to night school hustling franchises at the day looking at that file. It's some, Ivy Leaguer on the 40th floor in Manhattan whose sole purpose is to go through your files and tear them apart and find holes, so that then the private equity firm can kind of beat it up. And, we see that. And so we've engineered our system backwards, right? Is we've been on the due diligence side, buyers and sellers. We've been asked to do that. And you find out what's important to them, what really matters, what's their risk focus. And so when you're when you're thinking about the decisions you make as an early stage franchisor, you have to realize that once those decisions get locked in stone. Now, I was like, as a development person, a lot of lawyers say, and they're not wrong, that like, oh, you got to make sure that every T is crossed and every I is dotted. Because if you ever get in a fight with those franchisees and you ever have litigation with those franchisees, that's when it's really going to matter. And they're not wrong. It does matter. But hopefully that's like single digit percentage. If you're fighting with your franchisees all the time and in court, you're not getting the big exit. So, but I flip it around from the optimistic side, and I coach and tell our clients 100% when you finally, the whole reason you go through hiring a lawyer, getting CRM systems, going to the IFA, dealing with franchisees, getting those phone calls on the weekend, it's painful. It's a big journey. The whole reason a lot of people do that is so that the valuation at the back end, 5 to 7, 10 years from now, when you finally go to market, what are you bringing to market? I mean, what is a franchisor? It's your intellectual property, your general brand name, your ecosystem and relationships with franchisees. And the tangible part are all those franchise agreements and how enforceable they are and how solid they are and how that system looks. So that's your bucket. When you don't have 200 employees, you have 15 people running around and a couple $1 million in royalty revenue, and it's this mailbox money that's coming in and it's backed up by these franchise agreements. So they're so important. And it's not 3 that are looked at, it's 100% of them. So you'll work that system backwards about how can you build systems around making sure that you're ready to go to market. And when you start planning the exit, you start on day one before you're a franchisor, how you're going to be organized, because start with the end in mind, the old Stephen Covey stuff.
Yeah, well, I love it. One of the things that comes to my mind as we talk about this is that this is not just related to the franchising industry. The thing that investors love about this industry is the recurring revenue model of the royalties, right? That's where they find value. And if you're in any industry, I happen to have been in software for most of my career. It's the exact same valuation model. It's a multiple you'll get of your recurring revenue or EBITDA, but it's also like it's contract value. And there's a lot more value placed upon that. So I think it's interesting that even though it is different, this isn't the same as a software company, but the investors look at it very similarly.
I agree with you. I actually have been talking about that more and more, that I think there's a big analogy. I joke that franchising is like analog software, basically. It's software run by human beings. So you have a bunch of human beings running around who are doing something that you taught them how to do, and they're sending you money back to the home office every month. And that's basically the software model. And the other analogy of software, so the valuations are in software, and I think that's partially because of the success rate, because not every franchisor is successful, and we'll get into that. So I think that gives you those high valuations. And the other reason is that it's a long slog. For those of you who may be watching this and you're in your first couple of years and you're not actually making any money as a franchisor, you're on target, just like software companies. The first person that jumped in an Uber who wasn't like related to the founders and paid $10 to go across town, Uber didn't make any money on that deal. They lost money on that deal because it was a couple $1 million that got them to the point that you could take the ride. Well, not to the same extremities, but you have a franchisee and your system does, $500,000 in revenue at the franchisee level, and they pay 6%. Well, you're going to spend a lot more than 30 grand supporting that franchisee. So you're probably not making money on those first franchisees. But so then people say, well, then why would I ever franchise in the first place? The reason is it flips. It's this curve. If you have a successful business and you have 5 or 7 or 10 locations, you start running out of trusted managers and family members and cousins, and the 10th restaurant or unit becomes harder than the 9th, and the 11th is even harder than the 10th. Franchising is reversed. The first 10 are really hard, but then the 11th is easier than the 10th, and the 20th is easier than the 19th. And that's why then the valuations come in, because, this is now something that is scalable. So that's the exciting part of franchising, is you gotta recalibrate. You're in a different business when you're a franchisor. You're no longer in the consumer business. You're in the business to duplicate yourself and you're a coach and a teacher and you're teaching people to run a business, and the valuation is based on that and how well you are a coach and a teacher and how well that system is duplicatable. That's the valuation, even more than sort of the fundamentals.
Yeah, I love it. Well, Tom, let's shift gears, because what you said right there, I think, leads into one of the topics we ought to discuss, which is the things that that somebody who's looking to plan for the big exit today should be thinking about. And you were just talking almost around like the unit level economics, and you chatted about this with me previously. Talk to us a little bit about unit level economics and what should the franchisor be focused on, and why should they even be so focused on this particular aspect of running a franchise system?
Yeah, because I think this is something that, I mean, it's obvious, right, that the franchisees have to make money, but it's so obvious people go blind to it, that is really fundamentally the health of the system. And I have seen a trend over the last decade that I've been doing this, that people used to focus on how fast you were selling the franchise, unit growth and all that stuff. And I think people realized that those numbers can be poked and prodded, and you get the right salespeople and you can start doing a lot of numbers. And I think the strong private equity, the big valuations are coming when people, now I see that if you were to ask a private equity person and say, take the average P&L of the franchisee and the P&L of the franchisor, and which one's more important, I think most would say the P&L of the franchisee, because the franchisor, so even though traditionally it's the multiple of the earnings, the EBITDA of the franchisor, it's actually a secondary consideration to the earnings of the franchisee, because they know franchisees are able to make money if the fundamental business has solved something in the marketplace. Whereas, hey, because of our technology, we can do, and because of our buying power, and because of the quality of our brand, we can put roofs on better and faster, and we can be more profitable than the mom and pop. So we can compete everywhere in the country, and we're only in 20% of the country. That's the value prop, right? Now private equity comes in and they're going to fill in the rest of the green space. So if you're a franchisor, and this might also sound funny coming from a development guy, and I have a couple $100,000, now we all wish we had a couple $100,000 in discretionary investment money. Where's it better placed, in franchise development or in coaching, training, and back-end systems to make your franchisees profitable? If you're shooting for the moon valuation, you're better off investing in that, in making your franchisees more profitable. The sales and the development are a reward for a well-run system, not the other way around. And I think it used to be the other way around.
Yes, say that one more time, because I think that's a really critical soundbite for everyone listening.
Yeah, so I believe that the franchise development is the reward for a well-run system, not the other way around, that a well-run system comes out of a growing system. So you can get growth early, but if you don't have the fundamentals, it's the reward. So selling franchises is a reward for a job well done with your franchisees.
Yeah, I work with, I don't know, a couple hundred organizations doing franchise development, both on the consulting side, brokers, as well as on the actual franchisor side. And more and more and more, what I'm seeing, just, Dave's observations are very well aligned with what you're saying there, which is why I love that soundbite you just said.
Yeah,
is that the franchise. In fact, I'll share an anecdote, no names, but I was working with a gentleman, a little older, runs a home service franchise. We'll keep this very generic because I don't want anyone to ever intuit who it was. And he said, man, I need some help. It was actually, he was looking at the unit level technology with us. And I was like, great, what do you got? And he showed me the system that was not good at all. Like, it was terrible, but he thought it was amazing because he built it himself with his buddy. And it was not a CRM. It had no sales automation. And it just didn't meet the bare minimum expectations in the industry. So as a side note, as we're talking, like he tells me, after a couple of weeks, they were really excited about it. Like, wow, this will revolutionize everything. Then he comes back to me and says, well, sometimes you hear from people who are stuck in a rut, hey, we're just going to keep doing what we're doing. We think it's good. And I said, hey, look, I have no emotion attached to this other than I'm concerned about you because you told me you've been trying to sell franchises for 2 years. You haven't sold a single franchise, and you're in an industry where I know people are selling dozens of units a year. It's a very hot sector of home services. And I was like, I'm just going to be honest with you. The reason why is because when people try to validate you and compare you against what else is in the market, assume they're talking to 3 or 4 similar brands. They are seeing that they are completely different on the technology strategy. Their unit level operations are way better because they're investing in things like this. I said, I'm not trying to bully you into a decision, but you have to understand that your comparative, you are at the bottom of the stack of people who have strategy and are supporting their franchisees to grow and scale. Doesn't matter that your business model has worked for 30 years. You have to understand this. And I don't think he appreciated it very much, but I'm a pretty honest guy.
Listen, that's why I love being a lawyer. I get paid to tell the truth. So just like you got paid to tell the truth, at the end of the day, that's good. That's great advice, because one of the things, when we say, okay, well, what can we affect in our little world? Yeah. One of the changes and adjustments we made a few years ago is that, and other people have done this, is that the brand fund, we sometimes call it a brand and technology fund, and we build it and we bake into the language that a franchisor can make investments on things that are going to help drive the brand. I mean, if you're charging a 2% brand fund, is a billboard on I-95 helping as much as an investment in a back-end technology that allows your franchisees to have faster, cleaner client acquisitions? Because that's what's going to drive the business long term. So right. I hear you 100%. And you're competing against mom and pops on that side. So you have to have your act together to look well. But if you're just competing with mom and pops, you're mistaken. You're also competing against, hey, there's some big brands now. We can't hide in franchising anymore. It's getting professionalized. People are coming in and saying, man, we have these mom and pop guys who spent a couple $100,000 and turned them into $20 million businesses. What if we put $5 million into that business? What if we really invest in the franchisor? What if we build a platform? And now we're seeing that, hey, and we have all these service brands or all these food brands, and we have a number of clients that are platforms, and they're really focused on getting the back end right and putting the dollars. And look, we could do a whole nother podcast on what happens to the culture after it's bought and what should the owners experience. But put that all aside, they're throwing big money at it, and maybe the experience for the franchisee is going to be a little bit more professionalized. And so that's who you're now competing against. So you're right on point. There is a higher level of expectation of what's happening at your franchisee level. It's franchisee satisfaction, franchisees profitability, franchisee validation and happiness. Those are your ultimate drive. All our collective bills in franchising, mine included indirectly, are paid by how happy franchisees are writing those royalty checks. Yeah.
I think that's a home run. Guys, make sure, because if your validation process should be a home run. Like if anybody's really, if you do validations, and I'm hoping you do, but if you have people that are talking to your franchise owners, they should be singing praises. Occasionally you get the knucklehead that wants to kick against the system the whole time. But like if you're doing, just to reiterate, I think what you're really saying, Tom, is if you're doing your job very well as a franchisor, of focusing on unit level performance and success of the unit, then that part of the sales process is going to accelerate your close rates and expand, and people are going to be making their own noise. They're going to be referring their friends, and those are the best franchise owners, right? When you start creating an ecosystem of a culture of people wanting to bring other people into it that are also high performers, it's a home run.
Well, right, and your ultimate close is going to be that close to the private equity and your ultimate exit. So it's really not much different, except it's on steroids, different than selling a franchise. It's just everything is heightened, way more access to data, and a lot more to lose in terms of the deal not happening. And when you talk about planning the big exit, if you're a few years away from it, don't just brush those knuckleheads under the rug. Embrace them, grab them, have a conversation with them, and ask them, listen, Joe, Sally, I'm just getting the feeling that we're not meeting your expectations because you're not meeting ours. And before this relationship deteriorates any further, maybe we should think about a transfer, and we should find someone to step into your shoes to kind of mitigate your damages and get some money off the table. This business, I don't think this business is for you. Do you think it's for you? And one of two things happen. Well, one of three things happen. I guess the horrible thing is they get just so mad and they get worse. But that usually doesn't happen. The other two things happen. They say, you're right. This isn't what I expected. And I know I said I was going to quit my job, but I didn't. And I got my brother-in-law in there, and I just don't really like what you guys are doing. And I thought I was going to change the system, and I'm not super happy. Fine, then let's sell. Come on. Why should we be in this marriage here? I can't get out of it, but you can. And waive the transfer fee. Don't be penny wise and pound foolish. Oh, you write a $17,000 check to get someone out of your system every day of the week, and go get them out. Euthanize them, man. Get them moving. Get them out of there. And and the third thing that can happen is they're going to say, really? I thought I was being constructive. And now you can be a coach. Mm-hmm. You can say, look, you're not helping the system. Play ball. I'll reset. You want to reset? Let's start over. These are my expectations. This is what you need to follow. And I think it can go either way. Sometimes people just don't know. What a lot of franchisors do is they just ignore it. They say, oh, I have this problem. Well, I just got the. Now, you're always going to have a couple problem childs, but address it head on. Be a leader. Be a leader and a coach. And resales are something that people forget about, because the franchise development guys don't get compensated for it. The operations people think, well, that's not really part of my scope here. I'm just helping the current people. But you look at the statistics. If you focus on resales, you're going to see a 15 to 20% bump in the revenue of that new franchisee, because the new person comes in and says, oh, look at these systems. Oh, look at this awesome CRM that the old guy wasn't using. I think I'm actually going to use that. Let me go to the commerce. Let me talk to people about my business. And you always see that, but everybody kind of forgets about it because no one's really compensated. So if you're a franchisor and you're thinking about eventually exiting, exit the troublemakers before they're troublemakers, so you have a cleaner validation process and a better system for the next person.
Yeah, and also, how often does the equity group speak to the franchise owners?
I mean, 100% of the time. They all do. They validate. They want to talk to them. They want to find out. You're wearing your Sunday best. Of course, you're selling the deal. They're going to talk to them. Probably take a deeper dive, and they're going to hire a third party. Usually there are people out there who do that. So absolutely, they're going to do way, it's amazing to me that people who buy a franchise don't all do validation. They should. I mean, I always say you're crazy, but the reality is sometimes it's just, they go on their gut and they just go. No one's buying the system without doing that validation. So yeah, that's huge.
It's the ultimate validation, right? And that's where, again, I love that you brought that up, but handling the knuckleheads early, like think about, you got to be thinking, it's like playing chess, right? You got to be thinking 3 to 4 moves ahead. It doesn't matter what this pawn right now, but it matters where my queen's going to be 3 moves from now to put you in checkmate. You got to be thinking that way with the exit. And there's a lot more behind this, but you talked a minute ago about realistic expectations. And I think that's a topic that really relates to the franchisors that are planning the big exit. How do they manage their expectations of, like, what should I be doing now? What should that look like? When there's a lot of timing and other things we should be thinking about. But help us out, since you've been through this a lot, Tom. What should a franchisor be expecting?
Well, first thing is you have to understand what your numbers are. Mm-hmm. And you have to get any kind of big valuation, you got to be way past royalty break even, where the royalty dollars that are coming in on a monthly basis are supporting your system. Mm-hmm. And I think you'll have to also be realistic that there are a lot of buyers who have found franchising, and that at the risk of irritating some people and at the risk of sounding super insensitive, just because you got a letter that they said, hey, we have some people who are really interested in looking at your franchisor. You are not unique. Every single franchisor who is listed, this is all public stuff. You can find out. They all got the exact same letter. They're fishing. There's nothing wrong with that, but it's not special. It drives me nuts when I hear people are like, no. They tell me that, for every 100 deals they look at, they only really talk to 3. It's because only 3 people call them back. Yeah. That just means it's not 100 letters. Come on. You got to put yourself, that's your game. Don't just get stuck on one person. And there's nothing wrong also with bailing early, but you have to be realistic that you should get a partner early in the system to fill a non-financial deficiency. If you feel that you don't have the skill set of being a coach, if you get frustrated with your franchisees, if you're that guy who you mentioned before, who says, I don't want to invest in technology, my advice to him is, it's time to get a partner.
Mhm.
You know, run your business,
Yeah.
go get a partner out there, you know, keep a smaller piece of a bigger pie, but you're not equipped emotionally to be a franchisor. And there's nothing wrong with that. Not everybody is. It's a
Mhm.
different business. So know thyself, the timing, and recognize that every year that goes by, well, if you're an employer and you pay someone $100,000 a year, you have an expectation that that person is bringing you at a minimum more than $100,000 a year in revenue and profit. So you know, that's how the game works, right? That's how business works. So if someone's going to offer you $1 million, $10 million, or $100 million, it's worth more to them than whatever check they're going to write to you. And that's how business is played.
Mhm.
So you have to know that there's this very steep curve like software, that a normal business, if you have a service business, you do $1 million in revenue and you do $200,000 in profit, you're probably worth about $600,000.
Mhm. Yeah, 3x. Yeah.
Right, about 3x earnings. You roll that forward over the next 5 years. The reason it's 3x is because the million might go to $1,050,000, maybe go to 1.1 million, maybe 1.2 million. There's very incremental. Small business has very incremental growth and pretty solid profits, and that kind of dictates that. Whereas a franchisor is on that software curve. Whereas if you really get to 20, 50, 100 units, you're potentially going to rocket ship. So they're going to pay that same, you know, let's say it's $1 million, let's say it's $2 million or $3 million in royalties and 800,000, $1 million in profits at the franchisor level. That could be worth 15x, maybe more, depending on the industry. Well, why? Because it's not going to keep at $1 million a year. It's going to really skyrocket. So you just have to be realistic that every year that you hold on, the longer you hold on, and the farther up the exponential curve, you know, we were talking about skiing before behind you. So it's kind of reverse skiing, right? You're skiing up the mountain, which is pretty darn hard. But every couple of feet, you're able to muscle up that mountain. The faster you're gonna be able to go down because you're higher up. And it's the same kind of analogy. So you're pushing, the further you can push, the further you can hang on, the further you can go, the more valuable that you're going to be on the back end.
Yeah. Yeah, I want to break something down because being in the software world and being a fast growing firm, I've had 2 people this week reach out with similar phishing kind of automation messages, but there's something you said that I just want to reiterate around valuations because when we talked earlier about how important it is for a franchisor to focus on unit level economics, like help the franchisees succeed. It's not just because that improves your top line royalty revenue and then essentially your net income, or the line that they're looking at is this is the number I'm going to multiply to get to a valuation, but it's because this is how you impact that X, right? Your X factor is it going to be an 8x multiple of your earnings, or is it going to be a 12x, or going to be a 20x? Part of it is based upon, are you selling more units? Like, is the brand growing this way? And part of it is, are the units growing this way? And what you're saying earlier is the unit level performance is now heavier. It's got a heavier weighting than it used to have in the acquisition market. But you want to get to a 15, 20x exit on the, on your earnings. It's not going to be because your earnings are so high. It's going to be because your unit level performance is so high. And that's why we talked about it before. But as we're talking about valuations, I thought a lot of these folks don't know this world like I do, because I've just been involved in a lot of these discussions with private equity and people like that. Ultimately, we said, let's just get profitable and forget about private equity because we don't have to deal with the headache.
Right, because then you know that you're going to have a bigger exit, because now it's like you get it, the cake's a little bit baked. No, you're totally right. And be intentional about it, right? Don't just fall into it because it's the first guy that wants to take you on a date. Like, go out and get some suitors and be intentional, understand your value, understand the market, and have a plan and execute the plan, because that's what you did all this work for. Don't just kind of, oh man, this will be a little bit easier. Look, it's easier to say for me, sitting in my office, I'm just, hustling around your documents, and I'm not going through the stress every day to day. So I get it. I'm not saying it's not tempting to just bail, but do it intentionally. Do it intentionally.
Yeah. Well, and if you were going to build a deck on your house, how many bids would you get?
Right.
You're not just going to you're going to take the first bid and be like, yay, I got a deck. That might be the worst guy in town, right? Like you also need to know, who are the partners that you're working with. And once you get one, and this is, I had a great capital partner that we worked with early on, just a couple of years ago. And he said, look, you should always be getting a couple of offers. Once you get your first one that's coming to the table, you should be reaching out to several people you think are the right fit and let them know, hey, we're working on a deal right now. And they'll fast track you and say, well, maybe we should take a look at that deal if there's any interest or match, right, with their mandate. So you guys should.
I love that deck on the house analogy. You know, I'm a lawyer, so we professionally plagiarize. So I'm going to plagiarize that one.
Yeah, please do. Yeah. Build the deck, man. Most of my good stuff I've stolen from somebody else.
Oh, yeah. You borrowed and improved, we like to say.
Yeah, exactly. So let's talk about timing, because you brought this up a minute ago. I know a lot of guys are like, hey, I got 4 or 5 units. I think it's time, because they're eager for an exit. Maybe most entrepreneurs are a little ADHD, all the good ones, and they've got 3 more good ideas that don't have time to execute because they're building the franchise system. Let's go back to that partner discussion about that in a minute. But let's talk about timing. Like, when should they know? What are the signs they should be seeing that, hey, I think we're about ready, timing wise, size wise, whatever, to start entertaining the idea of an exit?
I would work backwards. I'd say, why'd we do this? Why'd we franchise? You know, what's the win for us? What's a financial win? Where do I want to get to? And, you know, and then also recognize your own shortcomings and your own risk. And there's a lot of folks out there who will invest in a company and let you kind of stay involved and stay engaged and keep some money, you know, take some cash off the table, but get a second bite at the apple. And that makes sense. Although you should realize that if you are that ADHD entrepreneur, you're probably not going to like going to work for somebody else and filling out a spreadsheet and the TPS report and all that. And I don't care what they say. We're different. They're not different. They're corporate. It's going to be a different world. It's okay, but you're not going to like working for them. So just, you know, don't count on that. It's extra if you do. So I would say the timing, it's a personal decision. I think you have to talk to your key advisors. You know, you need to have whoever that, like, those are conversations I have with my clients. Let's talk about it. There's no right answer. If you are starting to feel burned out and you're starting to feel you need some non-economic help in terms of building out your team, if you don't want to take the risk anymore of putting money forward, if you're not willing to lose money for tomorrow's big exit, maybe the timing is starting to get closer. It depends maybe where you are in your lifestyle, right? Are you at the point? I have one client. I mean, he's been a client for a very long time. The business is worth a lot of money. He's been approached by many people. And you know what his timing is? What am I going to do? My kids are grown. I love what I'm doing. I'm making money. I'm not selling. I don't want to sell because but that's a personal journey for him, right? So I think I think the timing is something you need to really be intentional about and talk to people. The longer you wait, the more value. So it's funny, right? It's a catch-22. That client I just mentioned, every year that goes by that they keep making money, he's worth more and more and more and more. He's like, oh, what am I going to do? Get 20, 30, 40 million dollars and go sit on a beach? Like, that's not fun to me. I like what I do. And so you have to be realistic about these are big numbers, right? These are big numbers that you're potentially talking about. You know, think about your life after that, especially as an entrepreneur. So the timing is the way to think about the timing is the longer you wait, the more valuable you are. Can you get there faster with an outside partner? Sure. But is that really going to fit where you are as a human? So it's funny. I always ask this question as I say, well, what's your goal? And people start telling me, well, I want to be at 50 units. I said, that's not what I asked. I said, what's your goal? As an entrepreneur, as an owner, why are you doing this and what do you want? And then work backwards to where the business should drive you. You should, you know, in that sense. So that's how I would answer that.
I tell it 2 cities, right? Tell it 2 owners. I've got 2, I'd consider both of them good friends now. One of them I've been working with since they had 8 units and now they've got 108 units and incredible culture, great human being. And I've talked to him because I've had people ask me, because I have a unique perspective. I can't share details, right? But they'll ask me, some of the folks that are investing in these groups say, hey, who do you know that is really rocking it in the industry right now? Well, I do know because I can see how they're doing. But I'll, you know, so when they ask, I'll say, you know, I know a few concepts that are really crushing it. You might want to talk to these guys or these guys, and, you know, great owners, great executive team. They're really growing and their unit level performance is fantastic. And I had one of them I chatted with, and this guy who's, just got hit the 108 mark this last year. He said, look, I don't want to sell. I don't want to sell. I don't want to exit, because same story, like what would I do? What would I do? And so, while you might think, hey, the big exit's the way to go, some of you might not want to exit. And this might be just that validation point you need in your life to say, you're right. I don't want to exit. I love what I do. I love my franchise family I'm building here. I like coaching people. I need some more help. So maybe I'll invest in some people and then focus on what I love to do. There are several people I know that have done that. They've sidelined themselves. Now they head up franchise development because they love to sell franchises, but they don't like to operate them, or opposite of that. It just depends. Like, find what you love. And if you are doing what you love every day, you don't work a day of your life. You'll enjoy it.
100%.
Yeah. Well, my friend, there's one other thing that we were going to talk about today, and we should wrap on this point because we're starting to run out of time together. But let's talk. You used the term the promised land when we were chatting before. Just to set realistic expectations with folks, right? Because this isn't for everyone. Not everyone builds a successful franchise. Not everyone even can build a successful business, let alone franchise. Can you help set some healthy expectations for folks, Tom? Like what should they expect as far as how likely are they to succeed at this? And not to be Debbie Downer, but just so they don't feel bad.
I think it's good. I think it's good to be Debbie Downer, actually, a little bit. It's like, because entrepreneurs come in with this full head of steam.
Mm-hmm.
I think you have to understand that franchising, you're playing the long game. I mean, I had a friend of mine, he did a study. This is now getting dated. It's probably about 10 years ago, but I think the numbers are really kind of true. He took 400 FDDs that had 0 units, right? They were new FTDs.
Mm-hmm.
5 years later, he looked at all 400 of those brands, and it was something like 120 of them had more than 5 units. So you're talking about, 1 out of 4 made it to just 5 units. Now, the cool thing was, of those 120 brands that got up to 5 units, it represented like 11,000 units. So there's big hits in there. So I think the expectations are, this is not a linear growth business. So you have to go in and you have to know that there's so many pitfalls. And so you just got to keep on, what are those pitfalls? We could do a whole show on that, right? Unit economics, the wrong franchisees, growing too fast or growing too slow, hitting that sweet spot. But it's, you invest a couple $100,000 in 7 to 10 years, and you pop out at the back end at $20 to $30 million. That's not a bad lottery ticket. That's not a bad lottery ticket. You can actually do some things to improve, but you have to know, I think the analogy I was telling you before, it's like you build a successful business, you're profitable, you do that to pay for your kids' college. And that's sort of the equivalent of you're a starter on a Division I college football team. Mm-hmm. You want to build a good franchisor, that's going to the Olympics and medaling in the Olympics at the big exit. That's paying for your grandkids' college. So it's generational wealth. Recalibrate. If your goal in life is to pay for your kids' college, live a good life, have success, go on a couple cruises with your wife, and chill out, don't build a franchise system. Go read the E-Myth and get a couple managers and get like 5 units, and life is grand. But if you want to really crush it and be known as an apex, entrepreneur, you build a franchise system, you coach people, you change people's lives, you create, 100 entrepreneurs behind you that you've changed their life, and you build generational wealth for your family. But no, you're climbing that mountain that's in the background there, Dave. That's no easy task. So go in knowing that it's a hard game. It's a winnable game, but it's a hard game.
Yeah. And just like that Olympic athlete that medals, their training schedule is every morning at 5, and they're eating the right food every day, and they don't cheat. And like, I got a daughter who's a figure skater, and she's 14, and she's up at 5 every morning on her own, working out in the basement, eating right. I offered her some peanut M&Ms the other day after we went and got some groceries. She's like, no, I've already had my sugar for the day. I'm like, you're 14. Like, but you got to have that kind of a mindset if you're going to make it through. Right. Because if you don't, you'll burn out, or you'll realize it's not for you. And then you can just enjoy the journey rather than focus on this giant exit, because it's in the news. We see the feeds in LinkedIn. Everyone feels like they're missing out because they're not exiting. Bull crap. Like, that's not what it has to be. I love that you said that. Like, focus on what your goal is. What's your why? And then align your roadmap of life around that why. That was great advice.
100%.
Yeah. Hey, you've been awesome. It sounds like we've got a couple more topics we should probably bring up. not again. But thanks again, Tom. Appreciate you.
Thanks, Dave.